Hope everyone's doing well. So, real quick, I don't have a lot of time, but I want to discuss just today and a few markets, and by the way, I'll try if I have some time in on this video, but I'm going to discuss more about scaling in an upcoming video at some point. But real quick, let's look at the spider and the Emini. So most markets you had a gap up, and we trended up for 5 or 6 bars. Here's Apple, trended up, Facebook. You can see here's the E-mini trended up. So I traded the spider and a few other stocks today. But really, let's look at bar 1. Let's review always in first. So always in on bar 1 is always in long, buy for any reason. What do you do up here? Well, I think bulls can get out over here, but the reality is most bulls gave up here and agreed that we're in trading range. And probably always in short here, but if bears sell, they've got to get out of shorts. And at this point, what's more likely, that we test here or test up? I think that we'll test up, but tight enough channel, the first up will fail. And as you can see right here, this move up, it never really became really always in long again. That's the problem. The E-mini shows the best picture. Look right here. So always in long, clearly probably always in short. So we're always in short. Arguably you sell, stop up here. And this rally never really became always in long. The bears just saw it as a pullback. Maybe 50%. So the bears, in hindsight, well, this is what happened in hindsight, but the bears saw it as simply a leg 1, leg 2 move. And we ended up falling below the low of the day, and we'll probably close the gap overnight. It's barely open. But the big thing with today is look to the left. Here's a 30-minute chart. And you can see we gapped up and tried to break above this high, and we couldn't. And look what happened on a 30-minute chart. Great bar 1, terrible follow through bar 2. Until you get a breakout, there is no breakout. And this is what I mean by scale in traders almost always. Let me back up. It's a limit order market. The bears who bet that the bulls are going to fail, somewhere in here they start selling, will be rewarded. And you can see bulls that bought this close at 26.62, they made 11 ticks. So they scalped out for 10 ticks. Price went to 26.73, exactly 11 ticks, enough to let them out. And that's it. But it took a long time. And the reality is today's a much better limit order day. It's a trading range. Trading range days, in general, if you do something reasonable, 90% of the time, if you use a wide stop and scale in, you can avoid a loss. And again, I say that if you do something reasonable. What I mean by that is buy any of these closes, scale and lower, you get out break even. Profit on the second. You sell up here, use a wide stop. You make money, You say, gee, a bear breakout, we're probably going to get a second leg down. Well, you just start buying in here and you scalp out with the profit. Traders do that all day long on trading range days. They sell down here, they scale in higher. Or, they say, pretty good bear channel down, but looks weak. Maybe I'll sell a pullback. And you can see, bulls get a breakout, bears sell it because they know that the odds are the bulls will be disappointed. Very often in trading range days, just look and look for trading range bars, and you can see, or look for trend bars. We have a set of bear breakout bars, but there's tails. They don't look that strong. It's at the moving average, and the bears are immediately disappointed. Strong bull bar. Bulls are immediately disappointed. If you really just take away, we had a gap here and a measure move down, but if you take away these trend bars and the rest of the bars were trading range bars. So think about it. 1, 2, 3, 4, 5, 6, 7, 8. There's really not that many trend bars on a day like today. And which goes to show you that 10% of the time the market's in a strong trend. And it's hard for one side to make money, easy for the other side to make money. So, that's kind of what I mean by, and that's what Al means, because I got that from Al. If you structure a trade in a reasonable way, you can almost always avoid a loss. Now, what do I mean by that? I don't mean, you buy all the way up here and you buy down here. And you can. Let's see if that worked, That's not really what I'm talking about. And you can see, you probably wouldn't have gotten out break even, but what if you bought this close? And then you bought more below a bear bar, above a bull bar, excuse me. You could have made money. Maybe you buy here, you buy below this bar, you could have made money. You got to kind of play with it, You're probably not going to buy, let's see if you would have bought, maybe you buy here, and you can see you wouldn't have gotten out. So, before I talk more about scaling in, let's just review a few other markets. So Apple, pretty much the same thing. Very strong, very parabolic, but when the market begins to go sideways for 20 bars, it loses its probability. So, at this point, odds are this is a bull flag, we're going to get more up. Now, and that's if I don't look to the left. So, but at some point, and ignore everything over here, but at some point, let me do it, well, it doesn't matter, but at some point, when we reach 20 bars of sideways, the market becomes very neutral, and the odds begin to favor more and more of this breakout failing. Tight channel, so, are the bulls giving up? Are we always in short? Well, I don't know, it's not that clear. And when it's not clear, bulls and bears usually will both make money. So bulls will buy down here, bears will sell, use a wide stop, and scale in. Bulls will buy, scale in. And you can see, bulls would have made money. And let's go back. So bulls, as I said, they will buy, scale in, make money. Bears, same thing. They'll sell, scale in up here. And look, they will make money. Bulls, they'll buy down here. Well, kind of forgot that it's 2 o'clock, but anyways, in general they would, but once you reach 2 o'clock, that becomes rather difficult. So Facebook, another good example, bull breakout. But again, look to the left. What do we have? Look up here. Big bear breakout. But if you manage the trade correctly and in a way that makes sense, you buy this close, you buy more lower, or you buy more, scalp out at your original entry. If you take a trade that's reasonable and manage it in a reasonable way, you'll make money. I'm not suggesting traders buy up here and then they buy all the way down here, use a really wide stop, and get out break even. I think you can. I think the logic actually makes sense, but I just don't think it's worth it doing that. What I'm simply saying is the bulls, they buy here, they buy maybe a percentage down, Or maybe they buy this low and they say, strong enough bear breakout, probably second leg. I'm going to buy somewhere in here. And they scalp out. The math works. And and at some point I'll prove it, but that's going to take a really long time to actually explain that. So Walmart, let's look at that. Walmart had a 30-minute chart. Walmart sideways. Look at these. This is a good example of trading range. Let's flip to a 15-minute chart and just look to the left. We open and we're trying to break out above. Well, what do you think is going to happen? Well, we're probably going to find sellers up here. So when this bar closes weak, guess what traders do? Traders sell it for a scalp. So this close was 69.68, and you could have made 10 cents. By the way, I wanted to look at Facebook on a 5-minute chart. If it'll load. Well, I can't access Facebook for some reason. I'm not quite sure why. Must be an internet issue. Anyways, let me briefly talk about scaling in for a minute. And we'll use this day as an example. So when you look at the day, and you see a doji, probably sellers above. So bears will sell more higher, make money. When this bar, you get a bear breakout, they'll sell, scale in, make money. In general, it's best to buy low and sell high in a trading range and scale in and scalp. It's much easier to make money if you sell up here and buy down here. You can see if a bear, let's see if you sold this close and you scaled in up here. You could sell here, you sell more below a bear bar, maybe this bar, and clearly you could have made money. Or you just sell in increments. You sell this close, sell up here, sell more up here, scalp out. But the reality is, new low of the day, trading range day, bulls will buy down here. And they'll scale in, they'll probably make money. The bulls who bought up here and scale in lower, guess what? They'll probably make money. So if you do reasonable things, you'll be rewarded, especially if you manage it correctly. If you really think about it, management's key. Most important, it is the most important thing behind trading. Your entry, if you think about it, it doesn't matter where you enter. And let me explain what I mean by that. Suppose you sold this close. And now, or better yet, let's say you sold below this bar. The price is now here. Well, guess what? You have from this low to this close. That's what, 50 cents? Something like that. So you have an open profit of, let's say, 45 cents. Well, guess what? There's no difference between selling up here, price being down here, and having 40 cents of open profit than if you were to simply wait and sell this close, put your stop up here. Your risk is the same. And let's look at, look over here. Look at this strong day we had, December the 7th. There's no difference buying this close or buying this close. Because, let me back up and explain what I mean by that. There's no difference between buying here and holding, or buying this close stop down here. If you buy and you're holding long right here, it's the exact same thing as buying up here, stop down here, because your risk is the same. If you buy this close and get stopped out down here, it'd be the exact same thing as if you bought here, price comes up to here and then stops you out. So that's basically why break even. There's no such thing as a break even stop. It's a flaw when people say that it's someone else's money, or it's just open profit, so I'm not really losing if I get out of break even. Well, you are losing. Here's a great example. Let's say you buy above this bar, you don't get out of here. You say you're stopped to break even right here, and you get stopped out over here. Well, guess what? You lost, 40, 50 cents. It's the same thing as buying up here and putting your stop here or down here. There's no difference. And, that is, if you don't agree with that, then you're not agreeing to the math. See, because what if somebody, let's use an example. Sure, let's say you sell here. Price goes, and you make this much profit. So you make, a few dollars, I don't know, $2.50. If you have $2.50 of profit, and you hold all the way up to here, and you get out here, you lost money. If there's no difference between selling down here and getting stopped out up here than selling here, writing this down, getting stopped out up here. And I'll explain that more, but think about it. Every tick changes the math. So comment below if you have any questions, and that's really all I have for today. Not really a lot to say. Overall, it was a trading range day, and traders who scalp, especially with limit orders, will be rewarded, and days like today are difficult for swing traders. So that's all I've got. Hope everyone has a good night. Thanks.